Well, hello. This is Danielle DiMartino Booth, and I'd like to welcome you to another episode of Down the Middle. Today, we have an extraordinary guest. I cannot be any prouder to be speaking with Howard Silverblatt of Standard & Poor's. He's been with S&P since 1977. I consider him to be the S&P 500, the index, if you will. And we have so much that we're going to be able to learn. So settle down, grab a drink. Howard, thank you, by the way, for being here. Appreciate all the time. We have something in common, the two of us. We don't have PhDs in economics. We don't have PhDs in finance. We don't have PhDs in anything. So I'm curious to know, this sets you apart from your siblings. You stopped after Syracuse University. Tell us why, because you're one of the most intelligent people I know, and I don't flatter you especially, but you're one of the most intelligent people I've ever met. What made you decide to get out of school and start your career as opposed to following the same path as your siblings and going all the way through a master's program or getting a PhD?
Yes, I am the family dropout, whether you want to use my siblings or you want to go to my parents or other relatives. I have no PhD at this point. Most of high school and junior high school, there was a lot of academics, a lot of pointing to academics. And growing up in the part of Brooklyn that I did, academics were important, but it was also the street. And between the two, growing up, I geared more towards the street, towards doing things and not as much academic and discussions, whether it be sports or whatever. And I kind of geared away. When I got to undergraduate, I that point considered potentially going farther. At least at that point, you would go straight on today after your undergraduate. You'd usually wait a little while unless it's a doctoral program. And I just decided that it was not for me at that point, and I needed to take a break. And if I wanted to go back to academia, it would be fairly easy. Even when I was in school, I remember my father still going to school, working on his second doctorate at that point. So I was kind of the outlier, and it was an amusing item, and it remains amusing to this point, considering how many academics I do deal with and how many dissertations I've worked on with people getting ABDs to work on stuff. They're a great way to get research done with a nominal cost. But yeah, I kind of shied away and I just never went back really to it. I did a couple of courses in different areas to see if I wanted to take something else up, but didn't go back.
So street smarts.
Well, a different way to look at it. Academic would have taken much longer. Streets were much quicker. Gratification. You got out, you got a job. You worked most of the day. You partied most of the night. You tried to get in the morning. And so it was perhaps short-sighted. In retrospect, should I have gone back to some other academics? I think so. When I started out, a lot of the academics were a lot easier than they are today. But the education I think I got by actually working hands-on compared to the, at that point, more book approach, theoretical approach, I think really did well on my side. And years later, I've been able to integrate the two.
Why Standard & Poor's? Well, first of all, who were you before S&P?
I was a student. S&P took me fresh and new, and I started there May 17th, 1977. The S&P was under 100.
Under 100.
So was Berkshire Hathaway. And we're not talking about the baby one. So I started back then. S&P was a much larger, the whole working place for financials was a much bigger pyramid then. So you picked a house and you stayed there for a couple of years, potentially moving up, but more likely moving out. So you would get a good broad education. I mean, I had to go through 10Ks, 10Qs, proxy statements, registration statements. I mean, they had a physical library, and if you wanted to do something, you used microfiche, which is no fun. Even during 10Q season, the earnings seasons now. I mean, we got our news from a ticker system where you would get the tape, literally cut it, and do a story or something and start researching something. And if it was on a stock, you might forward it to someone else. So it was a different time back then. The pyramids were much wider at the bottom. Today, they've kind of moved in. Back then, people did stay at companies for long times. Pensions were prevalent. There were no 401ks. Nothing was portable. If you worked for IBM, you got a dozen white shirts and you stayed there forever. Again, different times. Times have totally changed. The pyramid has changed. But I basically went to S&P to broaden that bottom line education and get some practical knowledge on there.
Something that I've learned from you over the years is that there's a church and state. There's a Chinese wall inside of S&P. There's the side of the business that you work in, and then there's another side. Was it always like that?
Yes and no. The wall when I first came was between the equity, which included stock analysts as well as the indexes, and the bond rating people, corporate and municipal. And you were not allowed to even deal with each other. You couldn't be on the same floor. At one point, we were on the same floor as one of the divisions, and they moved us a week later. If they only knew that I had been dating someone in the Munich, God knows what they would have done. But yeah, there was always a separation in that manner with ratings, because on an analytical side, you were looking, what's the company's cash flow? What's the projections? Not the ones that they're putting out, but what do they think is going to happen? What's the inside books? When they came in for a corporate rating, they opened up their books. They opened up everything they had, their cash flow, their internals, their plans and everything. So the sides were always separate. The index group back then was extremely small. I think it was about 5 full-time people, plus people they borrowed. I was a borrowed employee during earnings season, during at that point, which was the reshuffling and some other items. But it was a very small item until the index itself became trading. And at that point, as the index grew, it became a separation. The separation currently is between those who analyze and work on the attributes and index, as well as developing indexes, and those that maintain it. Those will be the ones that apply the rules. Those will be the ones that take it and say, okay, this issue should be taken out. This should be put in. What are the replacement issues? What's our goal on here to set up the model? The model both may work on it. In other words, we want 27% as an illustration, 27% of technology. I want 3.2% of energy, and go down, then try to emulate. Because again, the purpose of the index is to emulate the whole market. Mm-hmm. If S&P 500 semiconductors go up 4% and the market semiconductors go up 2%, we did not beat the market. We didn't do our job. Right. So the separation between the two groups, those that pick it basically and those that work the analytics, are totally separate. And literally there is not just a wall, but a different part of it. You can't get from one side into another. There's locked doors, there's different meeting rooms, there's different systems, even internally. If we were having a video now and it was just between people on one side as compared to the other, you're going to different sites. And if it's together, it's a different site. So it is extremely important to keep it, because our business relies on that. Just as the ratings and separation from the equity, 45 years ago did.
Right, of course. The S&P 500 itself, is that the longest history index in the country?
No, the Dow goes back to 1896, which is a lot more. And that's just a simple index. You add them up, you divide. It's very simple. It's the most commonly quoted number. Most people know it. If you walked out on the street, not on Wall Street, but if you just walked out on Main Street somewhere and asked who is in the Dow, most people could name a lot of issues. And if you name those issues, McDonald's, Apple, they would know what they do. and it's very familiar, and it's very simple to understand, add and divide. The S&P 500 is a lot more complicated. Again, it's 500.
It's 1927, is that right?
Well, it actually goes back to 1923.
Okay.
Let me start actually here. The S&P 500, as we know today, started trading in 1957, March. At that point, we combined four existing indices going back in time. Okay, basically the three primaries. Okay, so these indices backed up. So when we wanted to put the industrials, the transportation, which we actually call the railroads, and the utilities together to make the 500, which is what started trading in 1957, we took these back indices, redid the math. We didn't have to decide who is going to go in, where it's going to be classified, what the stock price was. It was just a matter of adding. So the 500 itself trades in 57, but some of the data, depending upon what you're using, goes back to 1923, with the most common data being 1928, when you start getting daily. When S&P started in 1923, it was a weekly index. There was no calculators. You had an abacus, and that was it. Even when I went, I had log scales. You had to look up natural logarithms. I know you don't want to hear about logarithms anymore, but
we in a post-COVID era, we put a lot of things on log scales. So unfortunately, we know what you're talking about. So,
but so really, it goes back to 1926. The pro forma from 28, excuse me, from 28 to 57. The pro forma though is actual, even though it didn't trade it, because it's the indices actually combined, put together what actually was there. But the trading is in 57. So yes, that's one of the older ones that exist. There are other railroad indices that go back to the 1800s. As I said, Dow Jones Indices has a Dow Jones itself that goes back to 1896 on there. So within the U.S., it is one of the older ones in existence.
So the Dow Jones was not always part of the S&P family. Am I getting it right or wrong?
That is correct. They are part of the Wall Street Journal. And they still have a representation on the determination of the committee to make up the Dow, but S&P combined with the indices only, not Dow Jones, which still exists in the Wall Street Journal, of course, as well, which is owned by Fox. But S&P combined the indices component and picked up the Dow itself. So now it was S&P indices, it is now S&P Dow Jones Indices. And we do have that along with the indices on there, and a whole family of them, both domestically and internationally.
And when was that merger, if you will?
That was 7 years ago. And we came together, and it was pretty good. I mean, we did have many questions for them. And it was amusing because if you call it the Apple situation, because the Dow is weighted by price, and before, not this split, but the prior split, and I remember many times S&P sitting there wondering, what's Dow going to do with this?
Yeah.
And I never got a full answer to it. But obviously, Apple did eventually split price, and S&P did put it into the Dow Jones averages. But again, the price was a big difficulty on there. It's a price-weighted 30 issues. You do not want dominance on there. And after the shift with Apple, its weight went down so much, and technology went down to about under 21% in the Dow. That was a concern. It was 27% one day, and the next day it's 21. That was part of the thinking, shall we say, and rationale on the replacement issues.
I can remember it was probably just 18 months ago that prior to the Boeing situation, that Boeing alone could swing the Dow on any given day when it was trading at its high point.
Boeing and Goldman before that. There is a concern about the pricing. If something gets too high or too low, it becomes almost irrelevant, where a stock on the higher end selling for several hundred could go up 5%. In today's market, that's not an unreasonable scenario. get something on the bottom at selling at, let's say, $15, could drop a third, and the top overlaps it. The amusing analogy is that if you put Berkshire Hathaway, the actual one, the hundreds of thousands, into the Dow, regardless of who you take out, and the next day, all the other companies go under to zero, but Berkshire goes up 10%. The Dow's up that day.
I love it.
Okay. There's difficulties on that kind of industry as compared to the 500 others. Everything has its pluses and minuses.
So walk us through the construct then, and paint us the differentiation between how the Dow is constructed and how the S&P 500 is constructed.
Sure. Again, the Dow goes back forever, 1896, when it was basically almost the only methodology you can use is to take an average. You couldn't start doing market capitalization, weightings. You just couldn't trade like that, obviously, and couldn't deal with it. So it was 30, and the intent was to represent the top end of the U.S. markets, not to totally emulate it, but to represent it. And that's kind of stayed true. It's not the 30 largest companies, and the weights are relevant, but the idea is to represent the U.S. And it's an important indice in that most people understand it. They use it to measure the economy. The S&P 500 is totally different and more of an investment tool. Not as many people use the Dow as an investment tool. It's 30 companies. And I guess I should say that over long periods of time, back to the 1920s, the S&P and the 500 pretty well correlate between themselves. On any short-term run, it usually does not. Again, because of the weightings. The S&P 500 is meant to fully emulate the U.S. domestic market. Again, that semiconductor, if the market's 2%, we need to do 2%. Healthcare, break it down to biopharmaceuticals. There's 11 main sectors within that we break down the index to, and 153 sub-industries. So you've got to emulate all of these on there. And the idea is that you compare the S&P 500 to the broader market. So if you're in the broader market and you're in the S&P, you correlate very well. For that reason, investors use that more as an investment tool. You can get into the general market, okay, as compared to picking stock. Okay, you may be passive, or you can get a little bit less passive by saying, yes, I'm in the S&P 500. However, I think technology is good. So there is a technology sector within the S&P 500. So I can go long or short on the 500. I can buy into energy, and I can weight them however I want. So the 500 plus all the iterations of it permit individuals and money managers to invest in the market in any manner and form they want. They could be totally passive, put it aside. That's the index. I am doing exactly how the market does. Or they could start to slant it a little. Even though they're using the 500, they can use different areas. And so the main difference is what the investability at this point. So
it wasn't always 11 main sectors.
No,
was it real estate?
It was 10. Real estate was taken out of financials. It was a subgroup on there. So we're able to, just as we were in 1957, since real estate existed, take that part out and do pro formas. So real estate was not always in there. Recently, we also had telecommunications, which was AT&T and Verizon redone and renamed communications. But the groups in there could change. Individual issues called reclassification, and every year we put out paperwork saying potential changes in the GICs. Those are global industry classifications. That's what the 11 and the 153 are. There's actually 4 11s. So we go through that and look for public comment and could change. Typically, that changes are made in September. I should also add that MSCI and S&P do the GICs. Yes, we are competitors. Yes, we do not work on too many things together. We are definitely rivals domestically and international, but we do work together on the GICs in order to maintain consistency across the board, and it's advantageous for both groups.
So S&P, Dow Jones, copacetic, one happy family on the indices side. What about MSCI?
MSCI is a competitor of S&P, both domestically and internationally. but there is one group within MSCI and S&P that worked together, and that was on what's called GICS, Global Industry Classification System. Those are the 11 sectors. There's actually 4 levels, coming down to 153 sub. In that field, both S&P and MSCI work together to classify each company on a company level, not just in the US, but globally. So whether it trades in the US or not, this permits indices to more consistency between them. It also permits better control on there. There's actually a product out there called GICS Direct, which is jointly owned with revenue sharing, of course. So when we draw upon it, whether it be S&P or MSCI or any of the products that use those, IBM is always in the same group. BP always in the same group, no matter who it is. If there is a change, it is made simultaneously at the same point. One database, right, wrong, or indifferent. So that really helps both indices. Should they have done it separately? At one point, MSCI had theirs, and we had ours. And then back in 2000, 2001, we got together as part of that group, and we worked out a methodology as well as a review and a revenue. I mean, as much as of a business decision on both sides as it was an academic one.
There's that word. So speaking of differences, in the financial media, when we see earnings displayed, how does what we think of as earnings, IBIS, FactSet, Bloomberg, how does that differ from how you gauge earnings?
Significantly during difficult times, not much otherwise. And we always seem to be in difficult times. FactSet, Cap IQ, IBIS, Zacks, First Call. What they do is they go out to the analysts, and when you're dealing with the S&P 500, you're dealing with a lot of coverage, and they may ask 40 analysts on there. Obviously, if you go down to small cap, you may only find one. But they'll ask the 40 analysts, what do you think this company is going to make? And they'll give a number. Sometimes they include things, sometimes they don't include things. And then they'll take them and put them through a test, throwing out the tail ends. Because again, you have 40, so you could throw 1 or 2 of them out to have that ability. Figuring out a mean, median, mode, standard deviation, a whole bunch of numbers that you could do with 40 or 45 companies on there. Each one of those houses has their own little niche. Okay, but basically, if you compare them, they're relatively close to each other as far as the numbers going out. S&P is different. S&P uses methodology. When you go over and you ask most analysts what Netflix might be, or Apple, they're going to typically exclude option expense. Okay, but when you look at the estimates on an older company, excuse the terminology, IBM, ADP, they typically include it. So there's an inconsistency there. That's how the individual analyst, because the analyst doing IBM is probably not the same one as doing Netflix. Okay, so again, the street estimate is based on what the covering analysts go. S&P, I can't treat Apple any differently than Netflix. And that goes for other things besides options, such as pensions. Pensions on the street for AT&T, Verizon typically are excluded because they are enormous. Yet for other companies like Boeing and Caterpillar, it's typically put in there. Okay, so again, when we get to S&P, we have methodology. We always include pension expense and always include option. Whether you like it or not, there's a consistency there. Okay, and we measure it there. We also
they're real. I mean, they're real and they're tangible.
They're real, and again, both sides here have important uses, and investors need to know, because if you're using the wrong estimates or numbers, and depending upon when you're trading, you could be making a big mistake. Again, the street estimates is what the analysts think, and if that number includes items, doesn't include, whatever it is, whether the analysts flipped a coin, that's what the analysts are thinking the houses did. When that number comes out at, let's say, 410, okay, you got to beat or not beat, and the aftermarket is going to move at that point in time based on that. It may change after the CEO has a conference or something, but it's going to move. So if you're a short-term investor, you're playing that number. You want what the street thinks, right or wrong, because that's what the market is going to react to on the short run. The S&P has the consistency. Okay, the positive is that you can compare AT&T, IBM, Netflix. It's all done on the same methodology. It's like a piece of wood there. You know exactly what you're getting. If you do not like options, you could strip them out because we put them in there. If you do not like pensions, you could strip them out. And if you wanted to say, how do I get the first call? Okay, find out which issues they're adding each item in and move it over. Okay, we are more of methodology. The traders very often will use the street numbers. The analysts, economists, and strategists will use the S&P numbers because they need the consistency.
Right.
Am I overpaying for the market, you know, for 2021 at this point? And if so, how much? What's my return on equity? What's my book values for the bank? They need to be able to look back in time and say, this industry is not just a 500, but each one of those 153 groups. You know, within the semiconductor, what is the R&D amount? What is the purchased R&D? What are these numbers on an actual factual number on there? So the S&P number very often will be different in harder times because the street analysts exclude on the estimate any unknown charges. So when the number comes in, it's excluded. On our side, even if we didn't know about the charge, we're doing it in retrospect. You came in, these were your September numbers, you had a charge, and we're taking it. The easiest example is the old tobacco settlement, which was a 26, but it was a 25-year agreement signed by many companies. They all signed the same piece of paper. Yet the analysts on the street for many of these companies excluded the charge and some included it. Same exact charge, same legal document. It's just how it was worded and which one company was doing it, whether it was more domestic or international. On the S&P side, we included it all. Again, maybe you didn't want to, and you could, and they were sizable, and you could take them out. So again,
but in theory, this was a one-time 26-year expense.
Right, but if you take a look at a balance sheet from 25 years ago, there's not a lot of things that are still on there.
Right, of course.
Current assets, but not a settlement like that. So if you're shorter term and you look at the market, those estimates are really important, and that's what you need to use. If you are looking to see historically how you fit in, compare companies. You're doing a run to say, you know, give me companies that have certain characteristics. You want methodology, not how the analysts at that point in time were thinking. Okay, right. And that can be restated on that side. On the index, we do not. Once the September quarter is over, which for us is December 31, you can restate every single number to December 31 for your third quarter. And we will use December 31 documents for the number. Okay, if you go January 1 and make a change, we will not make it. I don't care if you're Enron, it doesn't matter what the story is here. December 31, the quarter's over. This is the number, and it's marked historical. If we had a mistake, we're human, we will go back and restate it. And we did in 1988. It was the last one. It'll happen again, maybe not in my lifetime, but mistakes happen. But we close off the quarter. We will not restate it. There's other areas and other products that do restate it, and that's useful. You want to look at the new pro forma for a spin-off. You know, how does United Technology, the old United Technology, work today without Carrier? You know, what's the stories on those? So those are important, but on an index basis, it's history, pure history, and it has to be factual.
So I think there's been a lot more focus on S&P in 2020 than there's been in many years because of one particular car maker. So the burning question would be, what determines companies that make it into the index, and what determines companies that are dropped out of the index?
Sure. We're talking about discretionary changes, not there's a deal coming in and you have to take something out.
Right.
Okay. You obviously still have some discretion on who you put in, but not on who's going out. So discretionary changes basically go back to the intent and the purpose of the index, which is to emulate the U.S. domestic common market. So you have the index and you're looking at technology, and it's 27% of the index, and you feel that the market is saying 30%, which is not at this point in time anywhere near there, especially after the last 2 weeks. So you're looking at that at 27%, 30%, it should be. That means somewhere else is underrepresented, is overrepresented. You know, you might have 4% in energy instead of 2.5%. So you really need to keep these things in check. So you may not put in and take out an issue just totally on where its market value is or how it's been doing, okay? You need to emulate. So that's a very important item. Once you have those somewhat instead, and you're always looking forward, you've got a merger coming up in 2 months. You've got something from the mid-cap that's merging. The mid-cap issue is going to probably move up because it's getting so big. By the way, most of the inserts in recent years into the 500 is coming from the mid-cap. They move up. They get too high, they're much higher. It creates a difficulty with mid-cap indexes, you know, and portfolio managers, because they usually want to hold on to the issue because it's been going up.
Right.
But most of it goes into here. So once we have the sector and the industry broken down, you know, S&P, then you look at issues that qualify. So you have to have a list of companies that potentially could go in. We put out on the web the methodology for these. You mentioned, not actually directly, but Tesla. And one of the main issues on there is profitability on a GAAP, generally accepted accounting principle, for 12 months. Not the operating, not the street estimates or the S&P modified one, but actual GAAP. And GAAP is generally accepted accounting principle. These are the rules, whether you do it, I do it, or my kid does it. It has to be the same number. Could it be fraud in these numbers? Of course. But these are the numbers presented by the auditors. And Tesla did turn positive. That's why it got a lot of hype in there with the thinking that it would go in. But qualifying on a preliminary basis, and again, you go into more detail on it, but on the criteria does not put you in there. It just means that you are potentially on a list. When you come up, you go more detail into that, and it has to fit into the size. In Tesla's case, under the current GIC and classifications, automotive, as compared to Ford and GM, the question would theoretically be, are you represented properly in the automotive? Okay, or do you need more, or do you need less? And if you're properly represented, are there other issues that might be better to take that? In other words, they better perform with the market on there. So those are important items that have to be looked at. Tesla is an enormous issue. If it was at some point put in at the current or back when it became profitable, it would have been the largest issue ever put in to the index. Not to say that that is a difficulty. It's not the Dow. It's market weighted, so that's not an issue, nor is the performance on there. But there are certain criteria that the companies have to meet: profitability, liquidity, the ability to trade, because again, over 15% of the S&P 500 is indexed, which means that if an issue goes in or comes out, 15% has to go and buy it, whether it's the best decision or the worst decision, okay? So it needs liquidity on there. And that's also an important item in the indices.
Looking back, what are some of the most memorable additions and what are some of the most memorable dropouts from the index? And I mean, obviously we're going back a ways, but just in your mind's eye, what are some of the most memorable moments?
Nightmare on Elm Street, Yahoo. And I'm still waiting for NASDAQ to send us a bottle of champagne, which I think they owe us because of that. Yahoo back before it was put into the S&P 500 was a high-flying issue, obviously, but it wasn't owned by many institutions, something that institutions learned very quickly not to do. But they were not owned by a lot. So when S&P gave notice, a week's notice, that they are going to be putting it into the S&P 500, that stock shot up over the next week, almost 50%.
Oh my gosh.
Because the trades going across, you know, when you used to see the trades and you saw 30, 40, those were not 30, 40 blocks, those were shares. You saw 100 shares going through at a trade. Institutions running to get them from mom and pops who held them, or anyone. So there was an enormous amount of imbalance, 50% in a week, okay, for being put into the index. bottom line is that S&P had to put those issues, that issue in at a much higher price, while some other indices that might have had it in there got to see their index go all the way up. And a lot of them work under AUM, assets under management, so make more money on that. So I think it's fair to say that we should have gotten a bottle of champagne out of it.
I love it.
So that's but companies have enormously learned from that, and keeping different ways to trade. Obviously, you don't have to buy the stock directly. There's options and everything. So when issues come out within respect to the 500, usually an IPO, you wait a year. But when they come out, they actually do look to buy some of that or get some positions on there. When they go on the road shows, very often that, an issue that is a question: would you be eligible for the S&P 500? If so, when do you meet these criteria? And even when issues come out of the index with the idea that maybe they will come back at a later point in time, it's on the road trip. It comes up. So it's very, issue inclusions are very important. So again, Yahoo was the nightmare, okay? Not that bad, but it was a lesson that the whole street learned. The other memorable items, obviously, is when we took out the S&P foreign issues. And at that point, it was much easier to tell a U.S. company from a foreign one. Mm-hmm. And things like Seagram's came out. There were 7 issues. So it became a pure U.S. play, the S&P 500. Today, the S&P 500 still has what's considered all American companies, but they may be domiciled for tax reasons abroad, even though they're considered U.S. companies. And there's criteria to determine, what is and is not a pure U.S. company and therefore eligible. I should note that about 43% of S&P 500 sales are purely abroad. That means they are produced and they are sold abroad. They could be produced in Canada, sold in Japan, but if they're from the US and sold abroad, that's considered an export. But 43% of sales come from there. On the profitability side, it's extremely difficult. Only about a third of the companies, the last time we checked, report any kind of profitability numbers, domestic, and that's on a pre-tax operating basis. Good luck with the definitions.
Yeah.
On a tax basis. So we don't have large handles. On individual companies, you can sometimes come down, especially technologies. They give you good. Retail companies give you excellent foreign exposure numbers. The Tiffany's, for example, which obviously is now dealing on the merger, on there, things like McDonald's, which has enormous European presence, they will give you good numbers, but overall, you don't get a good net number.
And how has that 43% evolved over time? How much more multinational is corporate America?
Significantly, and you've seen changes. Part of it's accounting, part of it's real. Technology has become a lot more as chips have become more abroad. Exports, remember, in the U.S. used to be very few, and even now the exports, are specialized equipment, the old General Electric things for the nuclear power plants, which is not the current case. So technology has increased significantly. Oil is and energy is difficult because they changed accounting methodologies, but they have basically increased on their profit items. Healthcare is another group that has somewhat stayed flat after going up and then down. But again, that's a difficulty in international accounting. We have long advocated that more information is needed. The street would love it if I could build a matrix based on your healthcare company. You mine this stuff out in Ireland, you put it together in the UK, then ship it to Japan and put it back into dollar, to which you might hedge. We have, again, long advocated that you need better information on that. Companies do not want to do, because I and everyone else on the street, as well as you, will build a matrix. And when the yen goes up so much, or the pound does something, or the euro, you will build that in, and you'll come up with a list, and it'll tell you adjust your holdings in Intel by 0.02% or something. It'll be a black box. They'll instantaneously use the hedging and everything on there. which might be nice for people with PhDs in mathematics, but the trader that's still using their nose would not like it. But again, the accounting is very poor on that, and we have said that for years.
My first day at DLJ, back in the day, a gentleman by the name of Stan Nobby, who sat behind Warren Buffett at Columbia Business School, sat down the MBA trainees, and he said, you do not emerge from a bear market on the S&P until you have a single-digit price-to-earnings ratio. And he told us at the time that was 1981. And even though in 2009 we got close, we never really did get to a single-digit price-to-earnings ratio. Take us back to 1981, and presumably stocks were hated at that point, but dirt cheap.
Yeah, again, the PE ratio is important. Historically, we go back to 1936. Shiller takes it back, although he commingles some items back to 1870s and 1890s. He puts that on his webpage, by the way, if anyone wants to go to Yale.
That's amazing.
It is good data. I use it on a regular basis. Again, it's not official, but when you're looking for things, yes. Going back to the 80s, again, we're looking at a different time, looking at inflationary times, you're looking at Jimmy Carter, looking at tax rates, obviously with Reagan on the situation. The market was a totally different item in there. Also back there, what's very important is who is doing the trades. Okay, when I opened up a brokerage account in the late 70s, I had to wait almost a week. Okay, I had to bring down everything you could think of to the broker to show them that, you know, who I was, what the bank is, and everything. Now I could start a brokerage account and lose my money in 5 minutes. Okay, back then it was more money managers, pension funds, and they were seen as the stabilizer because they were going long term. Pensions were still very important back then. They are still today, but they're more of a dying breed, the defined pensions. So the market was different and the technology was totally different, but the approach was more fundamental. The PE ratio, is there a yield? Do you care about yield if you've got a good PE? What were all the ratios and the volumes? We're closer to what today would be considered a Japanese approach of asset conscious items. So it was totally different. You didn't have the hype, you didn't have individuals, you didn't have Robin Hood, you didn't have my son going in and buying something because it's nice today as compared to tomorrow. He's done well, but I would not like to measure his risk factor, risk rewards. But so again, back then it was more a different market on there. If you were looking for a single PE today, you probably wouldn't want to buy it because there'd be something wrong with the company. And we are still over 20 PE, over 20 on 2021 earnings, projected earnings. Okay, and the 2022 numbers, you're still relatively high, although those estimates are very soft. Back then, the major difference was who was controlling and buying the stock. Everybody went to the same B school. Whether they were domestic, international, okay? The U.S. dominated a lot more. The U.S. is now about 53% of global markets. Back then, it wasn't emerging markets. You know, the development was more European on there. So the U.S. dominated. So the U.S. pension funds, money managers, brokerage houses, okay, dominated the trades. And their approach was a lot more statistical, analytical, and a lot of them longer term.
So there have been a lot more ups in your career than there have been downs in the market. But what was it like? What were those days like in 1987? And how did 87 differ from 2000 and 2008?
Totally different. 87. It hit really quick. And I should say that I did not lose any money on that Monday. I lost it all on Friday. I had short-term options in the money. Yeah, and they were calls, they weren't puts. Yeah, $43,000 on one trade. Anyway, the difference there was the imbalance in the market, was the lack of control of what would and would not happen, the uncertainty of it. We have circuit breakers now. We have systems now. They did not exist back then. It was a pure imbalance. And the trades went on the floor. You've been on the floor now, but back then it was crowded. Okay, now it's a section. Okay,
It used to be five full rooms, and now it's one.
Crowded together. I think they keep 6 foot apart, so they're COVID compliant with no difficulty. But back then, the difficulty with the trades, the enormous imbalance of it, and the lack of liquidity, which also was a major issue, of course, in 2008, 2009, especially with the Lehman Brothers situation. But back then, you couldn't trade it quick enough. And as the market dropped, again, even before that Monday, there was concern. And it was almost panics in there. In your phone call you got over the weekend, you hoped it wasn't a margin. For Monday's 20% drop, it was just uncontrollable selling. It could have actually gone more down. There was some buying, but if you think the market's going down, why are you going to catch a falling knife?
Mm-hmm.
Its bottom picks it up, and get that what's called can I say dead cat bounce here?
Yes, absolutely.
When even going down, you hit a bottom, you pop up a little, even if you're going to go down more. But there's that trade in there. More traders back then that was short term, but it wasn't the algorithms that did it. Although there were some primitive ones, but it was more the trading imbalance on there, and it was mayhem. I mean, you've spoken to people from the exchange, which would be a nice interview for you to do on there for the remaining man. And it was a nightmare. And the uncertainty in the corporates, in the stock rooms was enormous. It was mayhem, uncontrollable, nothing like what you see statistically now, or that we've seen. And when you go to 2000 and when you go to 2008 and 9, remember it was dragged out over the time period. Even
right
before you had the bear, before you had the Lehman, it was the housing and the memos coming out of everywhere. Short-term problem, no difficulties. We're going to get back on it, and that will be it. And that dragged on and got worse. The trading got worse. And the liquidity dried up. Again, liquidity, a major issue back then, as it was now with COVID. Let us thank that. And the liquidity was a major issue for the 2008, 2009 as the housing went. And that was dragged down, but a lot slower than the 87 crash itself. And totally different than, let's say, the 2000, 2002 bear market. But the liquidity in 87, the liquidity in 8, 9, and definitely the liquidity in the COVID situation.
Alan Greenspan in 1996 used the words irrational exuberance, and then he did nothing. The
market kept going up.
Market kept going up. He could have requirements after that. Of course it did. But looking back to the late 1990s, what were the red flags on your screen? What were the tells?
Well, technology, just from an index point of view, went up, I think, 78 and 82, 75 to 85% each year. And that's the index. We're not talking about the high flyers. Back then, if you had an IPO in technology, obviously not an index issue, just buy it and sell it in a week. You put in for whatever shares you'll get and whatever.
A week in a day.
You take it, and you just get rid of it. I don't even ask to name what they do. Everything was on future expectations. And yes, you can draw some similarities to our recovery now. But technology was the main item. You did not need sales, You did not need profitability. You needed hits and a broad audience on there. That was a significant concern. Risk totally turned higher across the board. And it was not that it was not unknown. I mean, traders and portfolio managers had it. I mean, it was in the reports that you got and in the stats and in the, how the risk reward scenario has changed. But you were on a big roller coaster going up, and everyone expected it to eventually go down, but not getting out until we turned. And not everyone got out in time.
So Howard, let's shift gears here. Talk to me about share buybacks. They weren't always legal, but once companies were green lighted by Congress, how did that change the dynamic? And how did dividends play into that? A year ago, we were talking about record levels of share buybacks. Obviously, that's dissipated to some extent, but if I follow your data correctly, there are still some big companies out there that are still doing buybacks. So how have buybacks evolved? How have they influenced dividends? And what can we expect going forward?
Buybacks did start to come more into fad when the regulations were changed for several reasons. Companies saw them as a cheap way to protect their earnings. Especially technology, they used options a lot. So they would give you an option to buy the stock, say at $30. The stock was now, years later, $50. If you exercise that option, my EPS go up and go down because my shares go up. So they'd go into the market, they would buy it for $50. You give me the 30, it only cost me 20. Then very quickly after that, companies figured out they can adjust their earnings, okay? And this is why earnings per share and methodology and buyback need to be an undergraduate course, not a graduate course. Companies can go in and buy discretionary. In that case, it's usually controlled more by the board of directors than the actual day-to-day people, because it's so much more expensive. I go in and I buy that full share at $50. Okay, and I put this share in my treasury. I don't retire it because I can always use it later. In some European countries, you have to use it or lose it, but they put it in the treasury. And my share count now goes down. Okay, and at this point, that means my EPS go up. Well, EPS go up, that means my PE is less. I'm a bargain, like me before. Now, instead of having 18 PE, I have 17.6. And we've seen significant buying and adjusting because at one point in 2004 and 2005, I and other companies, we put out messages to our analysts: when you're doing your estimates, make sure you have the correct shares, because buybacks, we do so many of them. What would happen is the analysts used the wrong shares, and therefore they had a lower EPS. They might have had the right net, but they had the wrong EPS. So when that number came across the wire at 4 o'clock, I got a beat. What am I doing? I'm buying. Okay. And then the CFO and the numbers come out. It's not a beat. It's the share count adjusting. So literally, it was a major problem on there. SEC got involved with a whole bunch of stuff, but buybacks became very popular. At one point, a quarter of the companies bought back enough to significantly change their EPS. We believe that 4% is a significant amount because, again, year over year, you're comparing my PE. That means my PE has changed 4%. My EPS has changed 4%. We did some statistical testing. It came out to like 3.7 something. Good enough, make it 4%. And so we measure that. And that has gone up an average over 20% of the companies. So 1 in 5 companies you can typically pick out that have earnings that are a minimum of 4% higher because of the EPS. So this is impacted. And remember, those trades are actual physical trades. It's not option trades and gated. It's going to the floor or the system, putting in the trade. So you now have more buyers. My stock is worth more with 5 buyers than 4. Doesn't change my stock. So buybacks became an enormous item. It's what in the 70s and the 80s stock splits were. You announce a big buyback, your stock goes up. You've got support. It supports my stock. It adds to my EPS. It is a win-win situation. What's happened now is that because liquidity still remains the main issue, companies that can buy back have high cash flow, not just earnings, but cash flow. Apple's, Microsoft's, okay, they are continuing. And for that reason, in our last full quarter, 83% of the top 20 companies accounted for 83% of all the buybacks. You either did them or didn't. Other companies did not. Financials dropped over 90%, even after Warren went in and bought $5 billion in buybacks. Financial went down because the Fed, as you recall, came in, made comments, shock and dismay. Within 24 hours, the banks came out and said, I will not buy them for second quarter. I will not buy them for third quarter. Now they're not buying them for fourth quarter. So buybacks, as you say, went totally down from the plus 200 to 88 billion last quarter. This quarter, I'm looking for about 100, 101 billion. There is a potential, small, very small, for a buyback bonanza. If for some reason the market perceived that buybacks would be taxed significantly different next year. Go back a couple of weeks to when a pure Biden win was in there, and with including potentially the Senate, the House, and the White House. And the concern was that buybacks next year would be taxed differently. Companies couldn't do it. So it might have ended up, and it doesn't seem the scenario now, but the item was that use it or lose it. Go get them now, because you do them next year, it's going to cost you. The same with dividends. When tax rates went down, okay, companies did not pay, a lot of them did not pay Q4 dividends. They paid them at the beginning of January because you as a holder was getting more. Well, dividend tax is expected to totally change next year. Picture's not clear, but if you go through the agendas there, it's going to increase. So the question companies had to at least address internally, I've got a dividend that's going to be paid out, in January. Do I want to do it in December? A lot of the retailers use January, of course, on there. So do you want to pull it back? Those do not seem what's happening. But dividend, obviously, and buybacks are connected. Companies have so much to spend. COVID, of course, totally changed buybacks and dividends. Companies' cash flow was cut off, like a light going out. If you were a hotel or something, or a convention center or travel, you got no cash flow and you had enormous expenses. Companies had to prioritize their self. Okay, buybacks were the last thing. Typically, up to that point, you want to increase buybacks, you go to the board and they make a decision, do I want to do it or not? I have plenty of money. They could do whatever they want. Now, money, liquidity was the main issue. Because of that, buybacks took a far back seat. Okay, and we see that in the numbers. Dividends were a different situation. Companies didn't want to reduce their dividends, poor signaling. Those that had to, again, going back to the hotels, going back to those that had their cash flow done, we saw an enormous increase in suspensions, not cuts, but totally shut off. 42 companies in the S&P 500 alone suspended their dividends, not cut, but suspended them, because it was an immediate turn-off of cash flow. At this point, we're seeing dividends still continue. We are going to see a good year in dividends this year, considering everything. Q1 for dividends was a record. Okay, second quarter, since so many were already declared, came in very good. Q3 went all the way down in Q4. Bottom line for the year, actual money in your pocket on S&P 500 dividends, 1% down. Given everything, that's a good number for actual dividends. But what we're seeing in dividends is fewer companies are increasing them, and this is within the 500 as well as the U.S. common domestic market. Fewer are increasing, and the average increase, okay, for most companies, average increase is significantly been reduced to the 4% area from the 8 and 10% number. Those that have good cash flow and still have the money are increasing higher. We saw the Microsoft $1.5 billion more on there. So there are companies, again, that have cash flow that are doing buybacks and are doing dividends, but that's the minority in there. Mm-hmm. All dividends are holding their own. Okay, 1% down is not a bad number at all. It's not the 9.5% we were thinking of at the beginning of the year, and a lot of analysts made that 10%. Of course, you return to a nice double-digit number. But 1%, considering where we stand and where we looked at things in March, is very good. So dividends, definitely a positive item, especially with interest rates so low now, whether it be banks, bonds, certificates, whatever. There's nowhere to go. If you're looking for yield, you have money sitting on the side, you're not getting anything. You have to be there because you do not want to be an alternative. You don't want to be in the market. You don't want to be wherever it is. But you are not making money on the side. So yields are one of the few places to go. Within the 500, yields are about 1.7% in the index. But for those issues paying, it's 2.2%, which is still a very good yield. However, of course, there's risk. There's always risk in any investment. And it does you no good to get a good yield and have your stock tank.
Before we move on, I'm always fascinated when I get your quarterly buyback email, because Apple is immense in and of itself. You said 82% of the buybacks were concentrated in 20 companies. What does Apple alone represent?
Apple is at $17-18 billion on there for this quarter. That means it would probably be 17-18%, because I'm estimating about 101 billion. It is an enormous part of it. And again, if they have the cash flow, obviously they have the cash resources. I should also note, at the end of Q1, strangely enough, companies set a record for cash and equivalent on their books. Not that they were planning up. And the joke was that if we didn't get COVID, traders and investors would have started complaining, what do you do with all that money? And by the way, since COVID, we've seen an enormous increase in equity offerings, which counter any kind of buybacks, and debt offerings. Companies are loading up on cash. We're expecting another record when we get all of the Q3 number in. We don't have them yet, but we're expecting it because cash is the main item here. Liquidity is important. Apple has liquidity. It is continuing. A lot of companies that have cash flow are continuing with buybacks. So we are getting an enormous top-heavy situation on there. Banks and financials, obviously, are doing nothing for Q4. Nothing's been said about Q1, but the bottom line is, if it comes between buybacks and dividends, they're sticking with dividends.
You're talking about big companies. You're talking about concentration. Passive investing. What is the influence today? Because I saw a report a few days ago that said, I think passive investing is now 48% of assets under management, on its way to being half. And they're just comparing purely mutual funds to index funds. In any event, you may recall before John Bogle passed away, that he publicly came out and wrote that if passive investing was to become half of the market, theoretically, in time, that would actually not be a positive development. So what's your views on this? Because it's become an enormous force.
It's become a topic as well. At what point do certain investors, or a certain type of investment, whether it be an index or an individual investor or a fund that gets too big and can't continue on, impact outside? I think your 48% number, which I haven't seen, probably includes what we call emulators. And just to give you an idea of what an emulator is, they might buy, as an example, 70% of the S&P 500, directly, indirectly, instruments, however they do it. And then with the remaining 30%, attempt to beat the index. They could do that with 10, 20 shares, even less. I mean, it could be a small portfolio, but the bottom line is that they're not going to be that far away from the S&P 500. So I think that 48% might be a lot of those emulators. And we believe, I don't have documentation, because if I knew you were emulating the index, I would charge you a licensing fee. We believe that could be more than the 15% that's licensed. But to go to your passive situation on there, the passive within the S&P 500 emulates the U.S. domestic market. So these people are actually buying the U.S. market. And if S&P is doing its job properly, we are moving with them. Therefore, they still are investing, but they're not stock picking, okay, on there. Is it too big on there? That's a legitimate question, considering sizes of everything. But at this point, it does not. When you get everybody moving in and out of a stock at this initial point, it could be. But even when we put issues in and out of the index, the impact is not what it was when you and I started in the business. It's not that enormous. Just buy it or just sell it. It's going in there. Very often it's going into another fund, or it's already anticipated, because, again, going into 500, most of the companies were in the mid-cap, at least the largest reason to go in there. And when they come out, they may be going into a mid-cap, so you're switching funds. So the impact of the concentration is not as large and on a short-term basis as you would think. Are more people putting their money into passive investments? Yes. Is that because the index is so great and fantastic and marvelous? I think it would more be that they're more concerned with picking out the actual index stocks. And also investors that we see, as well as money managers, use the index as one component. So this is just like as an emulator. This is the market, and that's where I'm going to go. So I know I'm going to be near the market. but I think tech, again, will do better or worse. So I will go short or long. I think Apple is totally underpriced. I'm going to overweight. I am going to underweight Microsoft. And again, just as an example. Or I think Tesla's a great stock. It's not in the index. I'm buying it. So again, you see a lot of those, and you see a lot of other funds being used in there. Dividend funds, as a matter of fact, preferred funds are still very popular for income. They don't give you as much of a tax advantage, but they're set amounts on duration. So yes, the passive has been growing. I don't see it as a situation currently. It is definitely being reviewed everywhere because it's an issue and it needs to be looked at, like it or not.
So that's one aspect of today's market. The other that so many people talk about is concentration, the FANG stocks. Has there ever been a time in your career that you've seen this level of concentration in just a handful of names as we do today?
Korea, no, that's from 77. But if you go to the early 60s, you do see higher concentrations to the top 10, for example, in the high 20s. We hit over 29% at one point here for the top 10, which is enormous. It is spread out over that. At one point, pre-breakup, IBM and AT&T were close to 12% by themselves. IBM was supposed to come out with a new product, something about personal computers or something like that. So they were all backed up. And AT&T was before the breakup. So we've seen situations for issues on there, okay? But these top 10 we have not seen since the 60s. It was not that much there. It appears that in the 30s there also was, but we did not, the markets were totally different and the share counts were different situations, capitalization and float, which we use now. But you really can't find a current scenario where you get that much of an overweighting on the top. The positive item on it is that it's not just the market value. They are adding the earnings to it, not all equally, obviously Amazon, but when you look at Apple's profitability, whether you played it or not each quarter, it is there. Microsoft, the cash flow, these companies are there. So it's not the way you got some of the concentration at the end of 1999, when also was Microsoft, didn't have as much income, or Lucent Technologies. Or if you go back a couple months before that, AOL, if you recall those. So again, we're seeing a concentration. That is something to know and see what it is with and without it. We are up 10% without the top flyers. We are not. We were up a tiny tick, which in and of itself, even if you exclude those and say, okay, year to date, we're a tick up. Given all the economic data currently, not saying what we're going to be next month when everyone cures the world, but right now, that's a pretty good number. So yes, the concentration is at record levels.
Let's go into my wheelhouse for a minute. The quantitative easing era, monetary policy. You were around when Volcker didn't care about the markets. And it was a much different kind of a relationship between Wall Street and the Federal Reserve. How has that influence, in your view, historically speaking, changed? And more importantly, can the Fed ever stop? We've been told in the last few months that QE is now an official tool in the toolbox and that they will be using it on a regular basis. And I think the market has priced in that they're never, ever going to exit.
One of Biden's potentials was to dig up Arthur Burns. Who Volcker worked on them, by the way, when he was head of New York. The market is addicted to the Fed. Okay, we were addicted to some degree to buybacks, but the liquidity issue and the buyback is in there. I don't think you can make a good case that if they didn't do what they did, that during COVID, we would have these kind of markets. I think it would have been a lot more damage out there, significant damage, whether you measure by unemployment, companies, whatever it is. So liquidity possessive. Could they have done better? Historians will go back and say yes or no, but we have gotten addicted to that. And the Fed has signals that this will continue for a while. So the market has this built into every spreadsheet. No one's looking for the 10-year to go back to 16% Jimmy Carter times. not, 1.6 maybe you'll see on a couple of longer term ones, not even next year or the year after. So yes, the market is basing these in, that liquidity is there, financing is in there, and that you will buy anything out there that is broadly considered fixed income, regardless of how it's classified.
40 years of low interest rates, every once in a while in history, it's rare, but every once in a while, the market takes off and does its own bidding. I mean, theoretically, there's a bond vigilante left somewhere. They can't all be dead. What would interest rates being taken out of the control of the Fed, long maturity, what would rising interest rates, how would that factor into the market today? Because there's a lot of chatter about the potential for the bond market to divorce itself from monetary policy. That's just the chatter on the street, that we're going to be in a rising interest rate regime, that we're going to have fiscal spending as far as the eye can see, and that at some point that the Fed's going to lose control.
Obviously, higher deficits, and yes, inflation will eventually come back. Not to hopefully the Carter times, but to where it's well above that anywhere near 2% range on. But as far as the market goes, okay, right now we've got short term, you've got the numbers. So you assume that going forward, one of the scenarios, one of the branches, much higher spending, potentially borrowing through their creation on there, the expense on corporations. And again, we're looking from the market perspective. Okay, higher interest rates, but we are so far down compared to where it was 5 or 10 years ago. These numbers are significantly down, even with higher debt. Okay, I mean, a lot of numbers of when companies try to refinance, they've got to buy bonds that are much higher, calling them in on there. We haven't seen that since the 80s, Jenny Mays and those. So yes, higher interest rates will hurt the companies, but it'll also put money back. If we get a general increase, all those investors that we mentioned going into CDs and there's a lot of money sitting on the side. If it does not go into stock, they're going to get at least some more income in there. The corporations have enough sufficient cash on hand, access to liquidity, and in general, cash flow. Cash flow is not what it was, okay? Earnings are not what they were, especially when you do a cash flow. Remember, a lot of these charges were non-cash. It's a paper charge. It's going to change your depreciation. It's going to change your GAAP numbers, but the cash flow is different on there. Okay, so the companies on next several years, even if we get higher interest expense, we're going to have more stimulus, and they should more than compensate for that. From a market point of view, again, inflation farther down, higher interest rates down, how you pay for the deficit, how those bonds that are maturing. Okay, if all of a sudden it's not point something, but much higher numbers, very valid. And if you were to do this for a 20, 30 year, it's an enormous amount. I think you would put it on your top list of concerns for the economy. Looking at the debt levels, whether you want to do it as a percentage of GDP, whether you want to do whatever you want to do, average cost of capital to the government, with the debt going up as well, expected to go up more, is going to be a problem. Shorter term is a different situation, and the market obviously is a different interpretation.
A lot of people who have been investing for a long time, the Howard Marks of the world, they're sitting on record cash piles right now. And separately, I went out and I asked most of my buddies in your city, if you got to ask Howard Silverblatt one question, what would it be? And again, Schiller was out in the New York Times. Dr. Schiller was out in the New York Times with an op-ed a few weeks ago. It made a lot of waves. He basically said, stocks are really overvalued. He hasn't said that for years and years. He hasn't said that since 1999. But he came out and he said that. So the burning question on everybody's mind, again, after a good long run in stocks, is what is the tail risk? What could put us into a situation where all of these predictions are going to come true, that we're going into a lower, longer period of low stock market returns, unlike what we've become accustomed to?
A continuation of the COVID situation. Obviously, some companies are adjusting, and it's working for them, and the markets are adjusting to that. Just as when I walk on the streets, the restaurants are adjusting, with igloos and things that. But if you get a prolonged period of significant change, consumer spending, which used to be rule of thumb 70%, okay, and now everyone thinks it's higher because capital expenditure, while it's gone up slightly, has not kept up par. So going forward, what would hurt the market is a lack of expenditures by consumers, and COVID would continue that. You're not getting travel back yet. Again, this would be the scenario. Travel does not come back the way it is. So all those industries, all those people that had jobs, okay, are not going back. The hotels are a fraction, the airlines are a fraction, the manufacturing is reduced. So COVID remains a major item. Getting it under control, not necessarily with a cure, but a treatment and a way to monitor it, moving it from the death penalty to, gee, I had it, it was a terrible 2 weeks, is different. So COVID is the current main situation on it that could produce a drive. It would probably increase those that are doing well and make even a bigger pyramid. The up we said 29%, now that 20 under 27, we would see that go up. You would see the higher end making it more the, to use the analogy, a have and have not, in the market. Those that survive and those that don't. Eventually the market and the economy comes back into equilibrium. But there's a lot of pain in there, and that's what could do it. Again, we are paying over 20 PE on 2021. If I told you the PE was 20 now, you would think, under normal situations, you would say that's very high. It should be in the mid-teens. I'm looking ahead, the end of 2021, and we are over 20. So we are paying a lot now for what we believe is going to be tomorrow. And the market is all about expectations. It's what you expect to come in. Just like similar to the election, is what you expected, okay? And that's where you reallocate afterward, you get reality. The old idea of buy in anticipation, sell on reality. Okay, so yes, the market's anticipating a lot now. So a downturn is somewhere going to have to make itself felt. Okay, and we dropped over 30% in that February 19th to March 23rd time period. That's really quick to go down. I mean, it's not the 20% we had on in October of 87 a single day, but we dropped down significantly. And so if the market does not see and perceive that we are getting back to where we think they're going to be. Okay, we're not talking about a quarter, okay, moving it from Q3 to Q4, both in 2021, but now we're to 22, maybe you're going to have to see some adjustments to that. I mean, just so much you're going to discount back. So COVID would be the situation.
I have one final burning question for you, Howard. And I mean, just take your time, think about it.
Uh-oh.
The Mets or the Yankees?
You must be joking, Jack. Are you kidding me? If you get back to New York, you're buying. I am a Yankee.
I am buying. If I get back to New York, I'll be so happy to get back to New York. I'm happy to buy.
I am a Yankee fan. Have been.
I know that. I know this, Howard.
The whole routine. Don't even mess with me on it. It's hard to be a Met fan also. Those people that are really dedicated. Yankee people come in and out, but it is hard to be a Met fan. And they do have dedicated people there.
Well, Howard, I am going to be the first to say that I hope the next time you and I are sitting across from each other and going through a long form interview like this, that we are doing it in person. So take good care of New York, and thank you so much for all of your time today. We really, really appreciate it. This is Danielle DiMartino Booth, and this is Down the Middle. Thank you for your time today.